Regulatory and compliance issues. Financial regulations. Overview of key regulations affecting financial engineering. Financial regulations ensure market stability, investor protection, and system transparency. As financial engineering evolves, regulatory frameworks adapt to emerging challenges. Key regulations shaping financial practices include Dodd-Frank Wall Street Reform and Consumer Protection Act. Enacted after the 2008 financial crisis, this comprehensive reform aims to enhance transparency, oversight, and risk prevention. Key provisions. Volcker Rule limits banks' proprietary trading and investments in hedge private equity funds to reduce risks and conflicts of interest. Derivatives regulation requires regulated exchanges and clearinghouses for trading, with detailed transaction reporting to enhance transparency and lower counterparty risk. Consumer protection establishes the Consumer Financial Protection Bureau, CFPB, to ensure fairness in financial products and services. Basel III. Background. Basel III, developed by the Basel Committee on Banking Supervision, strengthens banking sector regulation, supervision, and risk management, building on Basel I and II to enhance bank resilience during financial stress. Key provisions. Capital requirements. Stricter standards with a focus on high-quality capital, requiring a minimum Common Equity Tier 1 (CET1) ratio to absorb losses. Liquidity standards. Introduces Liquidity Coverage Ratio, LCR, and Net Stable Funding Ratio, NSFR, to ensure banks withstand short and long-term stress. Leverage ratio sets a leverage limit to curb excessive risk-taking and enhance financial stability. Impact. Basel III reshapes financial engineering by influencing capital and liquidity requirements, affecting financial product design, pricing, and risk management. It heightens focus on capital adequacy and liquidity planning, driving innovation in financial strategies. MiFID II, Markets and Financial Instruments, Directive 2. Background. MiFID II, implemented by the European Union, improves financial markets and strengthens investor protection, addressing gaps from the financial crisis. Key provisions. Transparency requirements enforces pre- and post-trade transparency for financial instruments and mandates detailed trade reporting to regulators. Algorithmic trading sets risk controls and monitoring requirements for algorithmic trading, addressing risks from high-frequency and automated strategies. Investor protection enhances disclosure, suitability assessments, and conflict management to ensure clients receive clear, comprehensive product information. Impact. MiFID II reshapes financial engineering with stricter transparency and reporting mandates, influencing algorithmic and high-frequency trading. It prioritizes investor protection, fostering transparency in financial product development and trading practices. Solvency II. Background. Solvency II, the EU's regulatory framework for insurance, ensures financial stability and solvency through a risk-based approach, replacing Solvency I. Key provisions. Capital requirements. Risk-based standards require insurers to hold sufficient capital to meet obligations and endure adverse scenarios. Risk management. Mandates robust systems to manage underwriting, market, credit, and operational risks, including regular stress testing. Disclosure and reporting imposes detailed reporting on financial positions, risk exposures, and capital adequacy. Impact. Solvency II shapes financial engineering and insurance by driving risk-based capital requirements, enhancing risk management, and influencing the design, valuation, and investment strategies of insurance products. General Data Protection Regulation, GDPR. Background. GDPR, the EU's data protection regulation, safeguards personal data and privacy, affecting organizations processing such data within the EU, including financial institutions. Key provisions. Data protection requires explicit consent for data collection, secure storage, and measures against breaches. Transparency and accountability mandates clear communication about data practices and the appointment of data protection officers, DPOS, for compliance. Data subject rights grants rights to access, correct, or delete personal data, with organizations obligated to respond promptly. Impact. GDPR reshapes financial engineering by enforcing stringent data protection standards, influencing data management, and ensuring compliance. These requirements affect how financial products and services are developed and implemented. Compliance challenges: addressing regulatory requirements and ensuring compliance. Ensuring regulatory compliance in financial engineering requires balancing innovation with adherence to complex and evolving regulations. Key challenges and strategies include navigating complex regulatory frameworks, jurisdictional differences, variations in regional regulations increase administrative and legal complexity, regulatory updates. Constant changes in regulations demand ongoing adjustments to systems and practices. Centralized compliance management streamlines oversight and ensures consistency across jurisdictions. Regular training and updates keeps compliance teams informed and prepared for regulatory changes. Ensuring effective internal controls and auditing. Challenges: complexity of internal controls. Implementing and maintaining robust internal controls can be complex, especially in organizations with diverse and sophisticated financial operations. Audit fatigue. Frequent audits and compliance checks can lead to fatigue and resistance, potentially affecting the effectiveness of the auditing process. Strategies: regular audits and reviews. Conducting regular internal audits and reviews can help identify potential compliance issues and ensure that controls are functioning as intended. Continuous improvement. Emphasizing continuous improvement in internal controls and auditing processes can enhance effectiveness and adaptability to changing regulatory requirements. Engaging with regulators and industry groups. Challenges: regulatory uncertainty. Interpreting and responding to regulatory guidance and expectations can sometimes be uncertain and subject to varying interpretations. Industry dynamics. Rapid changes in the financial industry and technological advancements can outpace regulatory developments, creating compliance challenges. Strategies: active engagement. Proactively engaging with regulators and industry groups can provide clarity on regulatory expectations and influence the development of new regulations. Industry best practices. Adopting best practices shared by industry groups and peers can help enhance compliance efforts and address emerging challenges. Future trends in regulation. Emerging regulatory trends and their impact. Increased focus on technology and innovation. Trends: regulation of fintech and digital assets. As fintech and digital assets like cryptocurrencies become more prominent, regulators are creating frameworks to ensure market integrity and investor protection, addressing concerns like AML and market manipulation. Enhanced cybersecurity standards. With more reliance on technology, stricter cybersecurity regulations are expected to safeguard financial institutions from cyber threats and data breaches. Impact: compliance costs. Financial institutions will face higher costs for complying with new technology regulations and implementing necessary cybersecurity measures. Innovation and competition. While new regulations could be burdensome, they can also stimulate innovation and competition by providing clear guidelines for technological advancements in the financial sector. Enhanced focus on environmental, social, and governance (ESG) criteria. Trends: mandatory ESG reporting. Financial institutions are increasingly required to report on ESG factors, improving transparency. Regulations like the EU's SFDR mandate disclosures of how ESG considerations are integrated into investment decisions. Impact: investment strategies. Institutions will need to adjust investment strategies to align with ESG standards, potentially leading to new financial products.